Hello, I'm Silvia Amaro, Senior Correspondent at CNBC, and I'm today joined by Paulo Mauro. He is the Deputy Director at the IMF's Fiscal Affairs Department. Thank you so much for joining me today, Paulo. It's a pleasure to speak with you.
Hello.
Now, the purpose of our conversation today is mostly to look at inflation and the implications, really, because essentially since 2021, we have seen this huge surge in inflation, and of course, that has brought several consequences across several economies. So to start with, Paulo, could you just outline for us the link between fiscal policy and how that impacts inflation?
Absolutely. So our report looks at first the impact of inflation on public finances. It looks at the impact that inflation has on different groups in society, because inflation redistributes well-being across society. And then it turns to the question of what can fiscal policy do to help central banks in the fight against inflation. So perhaps I can say a few words about the impact of inflation on public finances. First of all, most visibly, inflation, particularly when it's surprise inflation, as happened in 2021, 2022, that reduces the real value of government debt. It erodes the value of government debt, which brings a little bit of relief to the government, if you will. It helps future taxpayers a little bit, but at the same time, it imposes a loss on bondholders. So that effect happens while inflation is surprising. Of course, as inflation becomes expected, that effect peters out. Likewise, inflation erodes fiscal deficits when it first happens, because governments set budgets with nominal ceilings on spending. So during the year, the real value of what the government spends is going to be lower, whereas revenues do rise in line with inflation, and therefore those two effects together imply that the deficit falls while inflation is a surprise. But again, that's an effect that peters out pretty soon. Again, there are redistributive impacts in society that go beyond this distinction between the government and bondholders, and I'm happy to elaborate on those. But let me say a few words about what you started from, which is the impact of fiscal policy on demand in the economy, and through that on inflationary pressures. One of the central messages of our report is that some degree of fiscal restraint, fiscal tightening at this time of high public debts and high inflation can help central banks not have to jack up interest rates as much. With fiscal restraint, central banks may still have to increase interest rates a little bit, but not as much as in the absence of fiscal restraint or fiscal tightening. And we also suggest that whereas the overall fiscal stance should be one of fiscal tightening, it's important that the government provides support to the more vulnerable groups in the population, provide some targeted transfers to the poorer segments to help them withstand this difficult time. We also show in our model that the cushioning effect on consumption is not only for the poorer segments, but actually for the overall economy. So we suggest that there is an advantage to the macroeconomic performance and also this distributional performance more generally.
I guess it's just important, really, to understand whether governments are actually helping or hindering the work of central banks. So let me ask you more precisely about what we have seen in several countries, really, with workers striking, asking for higher wages. If all of these workers were to get higher wages, doesn't that become a problem for central bankers trying to bring down inflation, at the same time also for the governments?
Right. So we've seen episodes of social turmoil. We've seen them right now. We've also seen them, frankly, before the inflation bout. We've seen them even prior to the pandemic. There's a general sense that the system is not working for everybody. And that's something that we really need to be very mindful of. But coming to your question, indeed, with inflation, what has happened is that consumer prices have gone up and wages have not kept pace. We look at this in a lot of detail using survey data for thousands of individuals in 2 advanced economies, 2 emerging markets, and 2 low-income countries. And what we find is that, first of all, real wages declined in commodity importing countries. And when we look more closely, this decline in real wages, or more generally real incomes, is something that in our data, as far as we can tell so far, perhaps the data will get better quality as time goes by, but so far it looks like proportionately, the real wage decline has been about the same for low-income groups and for high-income groups. That's a very important effect. But there are 2 more distributive impacts of inflation that I want to highlight at this time. The first is a redistribution away from net lenders towards net borrowers. So let me take the case of a young family that has just purchased a house. They have taken a mortgage, and that mortgage is at fixed interest rates. The real value of their mortgage repayments will be lower because inflation has eroded it. So in some ways, this young family is benefiting from inflation, whereas you might have an older family that has some savings in government bonds or, some deposits in a bank, and the real value of those savings is eroded by inflation. So what you're having is a redistribution away from net lenders towards net borrowers, which tends to be correlated in most countries with the redistribution from the old toward the young. That's particularly important in countries where credit markets, mortgage markets are existing, functional. In low-income countries, there's a perhaps even more important impact that was especially prominent during this very special bout of inflation. And that has to do with the fact that food prices rose faster than the overall consumer price index. So in a low-income country, particularly, poorer families consume a very large share of their income in the form of food. And for those families, this particular bout of inflation has been really, really harmful. So we have these 3 channels of inflation impacting distribution in the economy. It's very important that policymakers keep those in mind, because when they consider new measures, when they consider new reforms, they have to keep in mind that this is already happening. And so in shaping those new measures, they must make sure that they don't sort of hit the same groups twice, if you will.
Of course. And it's interesting because, of course, we're already seeing in the latest sets of inflation that the energy component has actually come down, but food prices are still relatively very high compared to previous years. So I actually want to dive a little bit into some of the action that we've seen from several governments in the wake of the energy crisis, particularly in Europe. Several governments announced quite a lot of stimulus packages, so then consumers would not face such high bills. And I'm just wondering whether you think that these actions were targeted enough not to compromise inflation. In other words, do you think that governments have actually done a good job to contain inflation with these packages, or are they actually making the situation even worse?
Well, so exactly as you say, one of the key features of this episode of inflation in 2021, 2022 was a very large increase in energy prices. And of course, with Russia's invasion of Ukraine, particularly in Europe, we saw a spike in electricity prices, in natural gas prices. And understandably, governments around the world took a plethora of measures, some of good quality, some of not so good quality, as you were indicating in your initial remarks. What we recommend in general terms is for support to be through cash transfers targeted to the most vulnerable groups, to be temporary, so as energy prices come down, some of these measures can be reduced. What we think is less appropriate are generalized energy subsidies because what those do is they don't provide the right incentives for people to conserve energy and for people and firms to shift away from fossil fuels toward renewables and greener forms of energy. So there's a climate change angle, there's also an energy security angle. So in terms of how to support people, there are ways of doing it that are temporary targeted and they don't add so much to the overall fiscal deficit. Again, at the macro level, this is the time for governments to tighten deficits, to reduce the need for central banks to jack up their interest rates as much.
It's all quite, it's so all interlinked, isn't it? Because I was just going to ask you now about the recent turmoil that we have seen in the banking sector, because some argue that this all started because the Federal Reserve has been increasing interest rates at a very aggressive pace. But the Fed is doing that, and other central banks are doing the same because inflation is so high. So I was just wondering whether do you think that there's a risk at this stage that inflation could actually spark a financial crisis?
So that's a very important question. Inflation, potential banking turbulence, those are critical themes going into our spring meetings next week. And there will be a lot of discussion. I'm happy to speak to the fiscal angle. There will be a lot more discussion on financial regulation from people who are better placed to do that at the spring meetings. But in general terms, what I can say is that, of course, there are multiple policymakers here involved and multiple policy tools. So, for example, a central bank has the policy rate, but it also has prudential regulation, financial supervision, and so on. And again, other people will be way more qualified than I am to speak to those. On the fiscal side, as you were pointing out, indeed, there is a link because, again, if the fiscal authorities undertake fiscal restraint, fiscal tightening, and reduce the need for the central banks to jack up interest rates as much, then perhaps that reduces the likelihood that a fast increase in interest rates might trigger further turbulence in the banking or the financial sector more generally. So there's something that fiscal authorities can do, but that's not the whole policy story, of course. I will say a couple more things on the fiscal side. First, historically, there have been, of course, instances in which banking crises have led to very large fiscal costs. And that's very important to keep in mind. The second point to make here is that when fiscal support is provided to a financial institution, when taxpayers' money is provided to support a financial institution, it's important that that taxpayers' money is safeguarded. So that support, be it in the form of guarantees or be it in the form of an equity injection, that support has to come with conditions on the behavior of the financial institution. Historically, depending on the particular gravity of the case, there have been losses for shareholders. There have been constraints on management so that they cannot pay dividends. There have been cases in which the management was replaced. There's a whole spectrum of conditions depending on the severity of the case. But the general principle here is that if public money is provided, there has to be a certain governance that comes with it. There has to be safeguards on the use of public money.
So some clear messages there, Paolo, from you to several governments. And of course, let's see how this will pan out. It seems that the situation, at least when it comes to this banking sector turmoil, is easing. But of course, let's keep monitoring those developments. Now, thank you to our audience for following our conversation. If you would like to read more about the IMF's analysis on inflation and its dynamics, check out the latest fiscal monitor. Of course, there will be a lot of important conversations as well coming up at the IMF's spring meeting. So stay tuned. And thank you again, Paolo, for your time today.
Thank you, Silvia.